VC is kind of like a team sport, but then you're also on your own when you're doing a deal.
Yes, it is true. It is a contradiction right there. It is impossible to problem solve alone, and more heads, more ideas, always better than just thinking on your own. But it is also a very lonely game because it comes down to the deal manager to be accountable, take ownership of the investment thesis behind every opportunity. How do you know which one is the winner, right? So it comes down to every investment manager to build the investment thesis ground up, develop the conviction, and be able to defend it.
Can you share an example of when you actually had to do this? Welcome to Hard Truths by Vertex. Today I'll be chatting with Puiyan Leung on the reflections and contradictions she observed after a decade in venture capital. She's a partner at vertexventures Southeast Asia and India and based in Singapore. Now let's talk to her. You've been in venture for a decade now, and when you started reflecting on your experience in venture for the last 10 years, you realized that venture capital has a lot of contradictions. So let's start with the personal one. Venture is supposed to be a finance job, but not all of them in venture generally have like a finance background, like yourself. Did you feel like an outsider when you first joined the VC industry?
Yeah. Thank you. It has been 10 years indeed. Yeah. And thinking back, actually, 2015 was a pretty exciting time for the Southeast Asia VC ecosystem, right? We were starting to see the first few mega deals. The VC funding for the ecosystem crossed like 2 billion for the first time in 2014. I was very excited to move from corporate operating role into VC. I was full of curiosity. I was full of hope, naivety also, but it was exciting. But I was also very nervous and anxious. And I think partly is about what you said. I did not come from what I thought could be a conventional background to get into VC. I was not trained in finance. I was not a startup founder before. I'm a woman, the list goes on. But through my observation over the years, and it is by observing, the industry here, the industry at large, people who have done very well for themselves as venture capitalists, I also have come to accept that there's no classical and conventional background for VC, right? And I think that's the interesting thing about the sector, because as VC, you are meant to look out for the next interesting thing. There should be no conventional background. Every background could be relevant to what could happen next. Whether you're an engineer, whether you are study humanities, whether you study finance, whether you were in academia, it could all work. I think what may matter more sometimes are the softer qualities of a VC, whether you have the mental agility, whether you have the humility to learn something new, whether you are curious enough, whether you're motivated to keep hunting, the list goes on.
You mentioned mental agility. What do you mean by that?
As a mainstream VC, I think we have the privilege to be exposed to many different sectors. And we can be hopping from consumer internet to fintech to deep tech to health and climate, and then we can come back to consumer again. So that's what I mean. Like, really, we have to be able to understand concepts quickly and yet ask the right question. We cannot be expert in all fields, but we have to be exposed enough to understand what the crux of the matter is at a given point in time. Perhaps that's what I mean.
Yeah. So that's a challenge also, and a contradiction again as a VC, right? So there are certain focus areas for the VC firms. So you have to specialize. At the same time, like you said, you have to also know a number of other sectors and technologies, etc. So how do you balance these two?
You are exactly right. I mean, in our line of work, our ability to do due diligence and value add to our portfolio companies could stay quite superficial if we do not read deeply into the topic. So in order to underwrite a company well, we need to talk to subject matter experts, industry experts. We need to read about the sector. We should talk to other portfolio companies in the same space to recognize pattern. And to value add, we need to constantly build our professional network to talk to as many people as possible in that domain so that they can become partners and collaborators with our portfolio. So it requires a certain level of discipline to develop some degree of expertise in the topics that interest us. But it could also be easy to go down the rabbit hole. You get too niche, and if you are too niche, you will lose the opportunity to cover a number of startups. And ultimately, we are a mainstream fund. So if we cannot afford to be too focused on one domain over another. And I guess there lies the beauty in our business. We have the privilege to be exposed to different topics. How do we manage it? I guess in reality, in a fund, actually within our fund, there are certain team members that are better known for certain topics. For example, if it's fintech, we might go to a certain colleague. If it's climate, go to another colleague. If it's SaaS, another colleague is more passionate about it. And why do we call them subject matter expert? It could be because they've done deals in that sector. It could be due to their own personal interests. It could be because they have come from a company that is in that particular domain before, for a variety of reasons. And I guess that's where it gets interesting. It can become quite collaborative within the fund. Whenever we underwrite a deal, it's not uncommon for the deal manager who sourced the deal to ask for help from another colleague and go, hey, let's work on this together. And it's completely up to us. But ultimately, it comes down to the deal manager having the right discipline to find out enough so that you can kind of move forward. I guess what has also guided me over the years is also to ask myself, so what, right? Like, so what if I read another 5 technical papers about a certain topic? Is it going to help me underwrite the company better? Is it going to help me help the company better? If it's not, then it's purely for intellectual curiosity. Then I can do it in my own time. It's not for work, right? But if it would, then it is worth doing another 5 more, right? So that is also what guides me.
Yeah, that's a good point. Sometimes you become intellectually curious and then you just waste a lot of time and it doesn't add value. So you're saying that the way you draw a line is by asking yourself, okay, if it's not adding value to doing a deal or support, then you just stop there.
I could still do it, but then it's not for the purpose of building my competency as a VC, right?
Yeah.
It could be just for hobby, right? And many of us have different type of interests, but for me, for us as VC, ultimately is about making returns to the fund. So whether it's to help us win a deal, to help us add value and increase shareholder value of our portfolio companies, that would make sense.
Okay. So we talked about specializing in a particular sector, but there are the generalists who also operate, and my feeling is that they assess the founders, and just doing that really well. They don't need to put in as much effort as in like a market analysis or anything else.
I guess it is not wrong, especially right, if you are a very, very early stage investor, right? So for seed or pre-seed investors, when they look at an opportunity, there is not much number to play with. You cannot really do cohort analysis. You can't talk about past pivots. But I guess even then, there is still some requirement on the investor to understand the market, understand where the clients and the demand drivers are as a sector, right? But it is true, as early stage investor, we have to underwrite the people as much as we underwrite the numbers. Both are important. Underwriting the founders is highly critical for early stage investors like us. Why? For many reasons. I think number one, it is not uncommon for us to find ourselves on a cap table of companies for 3, 5, 7, maybe even more number of years. It's a very, very long relationship. And if we do not have a good sense of what drives the founder, what motivates them, how they operate under pressure, how they operate during good times and bad, what kind of leader they are, we may find that our values become divergent and it's quite hard to collaborate on the basis with no mutual trust and no mutual respect. Also, I think during the course of a entrepreneurship journey, there would be bounds to be up and down. The market shift, team change, business model shift, technology shift. And ultimately, it comes down to the founding team, the ability to understand what is happening out there, pick up on signals that could be opportunity, pick up on signals that could mean risk, and pivot their strategy accordingly. So founders also need to have that level of mental agility, stamina, emotional stamina, physical stamina to ride through all of that. So it is very true. VC is also very much a people business. We need to look at both the numbers. We need to look at the people.
Yeah. So when we discussed specialization, you mentioned having other team members specializing in a different sector. So VC is kind of like a team sport,
It is.
but then you're also on your own when you're doing a deal.
Yes, it is true. It is true. It is a contradiction right there.
Yeah.
It is a very interesting conundrum. It's impossible to problem solve alone, and more hits, more ideas, always better than just thinking on your own. None of us would have complete coverage of all sectors, all business model, all technology, and it's important for us to be able to debate deals and collaborate and recognize pattern together. But it is also a very lonely game because ultimately it comes down to the deal manager to be accountable, take ownership of the investment thesis behind every opportunity. And I think studies have shown that it pays to take a contrarian view sometimes, right? And in VC, it's also known that the power law applies, right? A small subset of the portfolio will bring about outsized return for the rest of the fund. So it means that the deal managers of those portfolio companies are probably recognizing patterns that other people are not seeing. And so they are able to make those outsized bets. So it can become a lonely game because how do you know which one is the winner, right? And so it comes down to every investment manager to build the investment thesis ground up, develop the conviction, and be able to defend it. When and surely there will be a lot of debate that come, a lot of feedback, and they're all good feedback. But at the end, they come down to the deal manager to go, okay, do I think that it is a good investment? Why? Do I think that the market is big enough? Do I think the business model is sustainable? Do I think that this is the team that will make it to the very end? Do I think that I can work with the team? And it's down to him or her to be able to defend it in front of the investment committee and throughout the journey of the company, actually.
Actually, can you share an example of when you actually had to do this?
So many times, right? Every time we try to make a case in front of the investment committee, basically it's down to you and your deal team to make that pitch, to present the case. Even after investment, every time there's an opportunity for follow-on investment, right? Whether it's during good times or bad times, we make the case, I guess. But I guess I also take comfort, having said that, I also take comfort in the fact that we are operating on a very strong platform, right? So collectively, the team, the senior partners, my peers, the team members, they have a lot of experience, a lot of institutional knowledge, some battle scars, a lot of fresh ideas. So while it is a lonely game, it can get super scary because it's down to me to make the right judgment. I also take comfort in the fact that ultimately the platform is very strong and I can always lean on my colleagues, on my senior partners for guidance, for ideas, and to maybe make the journey a little easier.
Yeah, our managing partner, Ben Matthias, was telling that VC is like a fleet of ships where all the ships are moving in one direction.
Yeah.
Yeah. So going back to lonely, right? What makes this lonely?
perhaps in the middle of a night when I'm looking at financial models, a shareholder agreement, when I can't reconcile the numbers, it can get lonely. I think to put things in context, it's probably lonelier to be a founder than to be an investor, right? So I don't want to take that away, right? But what makes a VC job lonely? Let me give you an example. Let's say a opportunity come along. It's in a relatively new sector, nascent sector, or the business model is something that not many people have tried before. It's something new, right? So in order to underwrite it, you kind of have to put some effort into building the investment thesis, and without knowing that whether actually this is a good investment or not. But as VCs, we are all hunters. We need to be able to have some intuition and go after opportunity that we think are interesting. But maybe at the end of the journey, it may not be there. Maybe it's all in your imagination. So to me, part of the loneliness comes from that, right? Because you are hoping that, during the due diligence process, you may be finding the next unicorn. Actually, maybe along the way, there could be ups and downs. As you're talking to industry expert, as you look at the business model, as you are doing, market landscaping, you realize that, actually, maybe it is not as interesting as it
As
is.
I initially thought.
Yeah, but then maybe there's still something there, and you try to take the contrarian view. And then you start questioning yourself, am I becoming a mad scientist about this? So there sometimes can be a lot of self-doubt, at least for me, when I'm trying to build up my own case about certain opportunities. There would be many points during the journey up to the point where I think I have found my conviction. All the way through, there would be many times where I question myself, am I wasting time? I could be spending my time on managing my other portfolio. I could be using this time to chase after another opportunity. Is this worth it? Sometimes I find that maybe lonely or scary, maybe that's the word to put it.
So how do you get better at managing this?
This loneliness. As I mentioned, I think we are very privileged to be operating on a very strong platform. So over time, I have found myself to be more courageous, to talk about my own insecurities earlier on in my own journey. So when I spot an interesting opportunity that could also be a bit contrarian, I used to want to do a lot more work before I first present the idea to the team, because I don't want to look silly. I want to look like I have done my homework. And we should all still do that. But I also realized that it's no harm just to test the idea with my colleagues. They might have seen something in a similar space, or they could know someone who know more about the topic than I do. And then I chase down the leads from there. So asking for help early on definitely helped. And being thick-skinned about it, it pays off.
Yeah. So you mentioned about developing conviction, right? So sometimes when the market is hot, you have to also move fast. Otherwise, you lose out on the deal, right? So you can't afford to spend a lot of time. So you need to be thorough, but at the same time, quick. I guess that's also another contradiction of venture capital. So how do you manage this?
Yeah. I think first and foremost, we need to all have a bit of hunter instinct in us. Like, we need to consider every opportunity as if it could be something interesting. Otherwise, it's, very easy to get quite cynical in our business, right? Because the top of the funnel can get very wide, but in reality, I think even across most of the VC funds, you probably invest in less than 1 to 3% of the total number of deals that you see.
Yeah.
So 97 to 99% of the time, we are saying no to everything that comes through our door. It's easy to get lazy and go, it's just one of the other 99 other deals we pass, right? But if we do that, we could miss out on something very interesting. So I think what I've learned over the years by observing my senior partners, by observing my colleagues, and through my own lessons, is that we really need to have that hunter instinct in us. And if we think that something is interesting, we really can't let up on it.
Yeah.
We have to chase down and try to develop thesis as fast as possible. But that doesn't mean that we gloss over the detail because we still operate on a very high bar. Our due diligence process and our investment committee process is highly robust. And also not just because of that, right? If we make a mistake, we have to live with it for the next 3, 5, 7, 10 years because you can't just get out once you make an investment. So it is also in our interest to be very thorough, very prudent in our decision-making process. There's a saying, and it may sound a little cliche, that luck is kind of where preparation made opportunity. And I think that is so true, right? And it comes down to your earlier question about being a generalist or having some domain expertise. If, throughout the year, you have been spending incremental amount of time reading a little bit more, talking to a few more people, meeting a few more companies, diving deeper into a certain sector or topic of your interest, inevitably, after 12 months, right, you would get better at recognizing patterns, understanding what makes a good company, what are the risk factor of a certain sector. It has to be the case, right? Nothing will go to waste. So then when a new opportunity come along in that sector, it becomes easier, to develop the right framework, mental framework, mental models to evaluate that opportunity. That definitely helps. That will give you the ability to move a lot quicker than your peers, your competitors, to evaluate you. I guess being open about sectors that interest us with the community also definitely help. So I think you have done a great job, and the entire team is behind the idea of publishing, sharing our thought process about certain sectors, certain domains. If you visit our website, if you visit our Medium, if you visit our LinkedIn, the different team members have all talked passionately about topics that interest them, that are important to them. And I think that also in a way has helped to share with the community, share with founders, share with the ecosystem how we think about certain topics. People may not agree with 100% of the things that we say, but at least by sharing our thought process, sharing our rationale, like-minded founders, like-minded co-investors may go, oh, okay, that resonate with me. And they will come forward with opportunities that they think are relevant to how we think. And when there's meeting of mind, when there's chemistry, actually things can move much more quickly.
Yeah, for sure. Having a prepared mind and sharing it definitely attracts people, the right sort of founders and other co-investors to you. So going back to, you mentioned it's easy to say no because it's a wide top of the funnel. Yeah, actually, this is so true. I've had another VC tell me that it's more difficult to say yes. And he named his VC firm Yes VC to make a point.
Yeah, it is, right? I mean, in comedy, there's a concept called yes and, right? It's easy to say no and the opportunity stops there. There's no way for people to build on new ideas. But if you are able to say yes and kind of build on that, and then the possibility could be limitless. But sometimes it's very hard, right? Like you have to kind of triage very quickly where you want to spend your time. Because at any given day, in any given week, you have to think about new sectors. You have to hunt deals that you're chasing. You have to work with your portfolio companies, address issues, many other things, right? So it's easier said than done. Yeah.
And can you share one scenario where you had to move fast and maybe did not have the time to be thorough with diligence? And also another example of the reverse.
The one example of whether I have to move fast, and many founders at the end of the first introductory meeting, maybe, right? And I will usually ask founders, do you have any question for me? Because throughout the hour, I would have asked a lot of questions. And I would typically ask the founders, do you have any question for me? And more often than not, founders would ask, how long do you take to make a decision? What is your process like? And I will tell them this, and this is the truth. During my 6 years here as in Vertex, I have seen deals done very quickly within a few weeks. And I have seen deals that have taken months and months to brew and they're still cooking, right? And it is not a function of when we can call the IC to meet, because the IC can meet many times, right? It is a function of how long it may take for the team to build up the investment conviction. I have always told founders this. It could take just a few weeks for a deal to get done, but it could also take months for something to cook and we're still waiting for the answer. I think at the end of the day, it comes down to how fast the deal team can form the investment thesis and do enough deep work to get comfort around a given opportunity, the size of the market, the financial modeling, the historical numbers, are they real or not, the founding team, etc., customer calls, expert calls, etc. Have there been examples where I wish I have been given more time to do due diligence? Yes, of course. But when a deal is competitive, then you have to move faster. And how do we solve that? We have included more deal team members into the deal team so that we can kind of divide and conquer, right? We have done that and we have been able to successfully win deals, even in very, very time-constrained manner. And have I wished that I could have done more work to be more thorough in my decision-making? Yes, I also have, right? So I think it really depends on the given opportunity at that point in time, but the level of rigor cannot be compromised. And sometimes speed is also very important. Otherwise, we might lose the opportunity.
Yeah. It's like you said earlier, you need to have that hunter mindset where you have to move fast if you want to get things done. So another thing with venture is, I think you've mentioned earlier, the power law. So very few companies actually drive the returns for the firm.
Yeah.
But you are investing in every company thinking that this would become like a big, large outcome or a large business. So that's a very conflicting thought again, right?
It is.
Like you have 10 portfolios, but you know that not all of them are going to be $1 billion company.
Yeah, I was just checking out some stats before today's session, and I think Carter published some data late last year. The graduation rate for Series A company to make it to Series B within 2 years for some of the more recent cohort is 9%. What does that actually mean? It means only 9% of the Series A company that you fund today will make it to Series B in 2 years' time. Some would actually die. Some may take much longer to raise Series B. And it actually means that 9 out of 10 Series A company may not make it to Series B. And by the way, we are Series A investors. So that is the kind of odds that we are dealing with. But we don't know which one is the 1 in 10 that will make it to Series B and beyond.
So you still have to fight for every single one of your investment, right?
We still have to fight for every investment because actually there's no place for complacency. A company could have successfully raised Series B from Series A and got a very decent markup, but that's just markup on your books. It ain't over till it's over until they actually return money for the fund. And from Series B to beyond, there could be many ups and downs again. A company that had been marked up once could be marked down the next round. You really never know. And the converse is true. A company that is, suffering a bad patch, all it takes could be one smart pivot or the market dynamics to shift, or maybe a bit of luck, and the trajectory could be changed all over again. We have to keep fighting for every single company. Things could change very quickly. We could not give up. But at the end of the day, every VC fund has finite resources. Regardless of your fund size, it's finite. Every VC fund has a fixed duration to the fund life. Usually it's 10 plus 2. So the reality is at the end of the day, some hard choices have to be made. You cannot keep supporting every company the same all the way. Naturally, after some point in time, you try to double down on what you think could be the winners, and you may reduce attention and resources on other companies that you don't think may kind of make back the money for the fund. And How do we make that call is really never easy. But if I were to put some framework around it, maybe I could categorize it into two main buckets, right? The first bucket relate to the market and the business. If after going at it for a number of years, we're still not convinced that there's a market there, right? The market demand never came. Or we're not convinced that the business model actually works. The unit economics get worse every time you grow, or there's no clear pathway to sustainable growth. Then actually there's a very fundamental question about whether this business could thrive in the long run, right? Then it calls for a very logical and rational discussion with the founding team what the future of the company could be, right?
But founders are not logical, no? They will. So a committed founder will never see.
I have a lot of respect for founders. There's so much sacrifices they have to make to start something new, to take that leap of faith, right? And of course, they need to be visionaries to be able to see a world that no other person can see, to be able to be motivated to continue to do what they do every day. But it has to come with results though, right? So then I think that maybe brings me to my next point, right? I think looking at our fund's history, we are not a fair weather investor, right? There will be many founders who will be able to hopefully share stories about how we have remained quite collaborative throughout the good times and the bad. But I guess at a certain point, if it becomes also clear that our values and our views become quite divergent from how the founders are thinking about a particular situation, then at some point maybe we have to agree to disagree and go, okay, you feel that this is your path. I think I cannot be part of that journey anymore. Then it also has to be a rational discussion about what happens then, right? The fact that we think we can no longer support a team on their journey doesn't mean that they have to stop the journey. Then it calls for a rational discussion.
So how do you go about doing such a difficult conversation?
Oh my goodness, it's never easy, right? It doesn't happen every week, every day. Is thankfully not a typical situation I have to get into on a daily basis. But whenever it happens, and it happens sometimes often enough, it's still quite difficult. Because you're telling your founder who you have worked with for a number of years, you say, okay, I think our journey ends here. Breakup is never easy, right? But what I have found useful, and also based on observation of how more senior colleagues have done it, is that communication early on, your expectation and on your approach, on your decision-making process is quite key. Whether it is expectation on how the market should shift, or expectation on how the founders can think about growth, or how we can support the company, all this should have been made clear as part of your daily interaction with the founders. And if and when it's time to say goodbye, hopefully it's not a surprise to anyone. Yeah.
So we talked about supporting all the investment, right? But then there is also like you're just an individual. So there is so much you can do from a value add support after you make an investment. So how do you manage that? This is again an contradiction, right? Because every portfolio would expect maximum support from you, but you as a person still have to prioritize. How do you go about doing this?
Yeah, I think the beauty of our business is that there is no typical day. And there's also no typical type of question or the help and the ways that the founders expect us to collaborate with them. Right? Some founders may come to us because they want to sharpen their fundraising strategy. Some founders may come to us because they want us to open doors for them. Some may have some hiring needs. Some just need some help with financial or corporate governance. And I think the interesting thing is, we as investors, we are not necessarily in control on when those things happen. So, you could have a peaceful morning, and then by afternoon, 4 of your portfolio come to you and go, I need help with A, B, C, and D, and you have to address them. But I think what I've tried to do to be able to stay clear-headed, at any given time, I try to stay present for that particular founder for that block of time, right? So I try not to get distracted by other topics, and that hour, let's focus on problem solving and talking about what you need. And actually, many times, things don't get resolved within an hour of conversation. What I also find is helpful is that we collaboratively need to be quite clear-headed about what additional information or what additional actions that must be taken to help us move along so that we can kind of start tracking. And so we can always then come back to it when things get done or additional information is available, then we can continue. So we have the action plan. What I also realize is important is I must always have the discipline to try to improve on my own, to be better at the sectors, at the topics, at the domain that my founders are working on, so that I can always be a credible collaborator to them. Otherwise, actually, they don't need to come to me. They would just, then we are not giving any interesting value add beyond capital. And we should all take it upon ourselves to always improve, to be a credible collaborator and partner to our startup. But I guess at the end of the day, you ask where to draw the line, right? I also find that it's important for us to recognize and be humble enough to recognize that actually it's the founders who are in the driver's seat. They are involved in the day-to-day. They are closest to the situation. They're closest to the problem. And they are the operator. So we have to give the founders that space to have the creativity, to have time to imagine, to have the space and time to do what they think is right for the company. When there's a fighting situation, you're there for the founders, but then you don't become a helicopter parent and start to micromanage. I think that would become quite dire. But it's an interesting dance. I have to say, it's something that I'm still trying to find the right balance because every deal is so personal to you.
Yeah, you feel committed, right? It's
You
like
feel
your own
committed,
thing.
but you cannot overstep, right? I guess it also depends on the founder in question. Some will proactively come to you and they're quite specific about what they want from you and you respect that, right? Some are like, okay, you're the first port of call when they have a new idea. Then you kind of need to respond to that to be able to dance and tango. So yeah, I think founder-investor chemistry is quite important.
Yeah. The one thing that I've noticed very early on interacting with VCs is that they refer to their portfolio company as we. So it's like they're also part of the team. You'll find that with every VC. So it's a total commitment. But context switching is very hard, right? Throughout the day, like you said, you're supporting the portfolio. But like we previously discussed, we also have to go and hunt for new deals. How do you do this within the day?
It's a good question. We just do it. I really enjoy what I'm doing. It's very demanding. It stretches me. It requires a lot of stamina. But I think it's a great privilege to be in a position to collaborate with people who think they can change the world. So I find this energizing. Compartmentalizing and being present is quite key, right? I mean, one moment I could be diving deep into a Excel spreadsheet and, or handling an administrative matter like clearing a contract. And then the next I need to go, okay, develop an investment thesis. So you kind of have to be present at what at least I find that it's useful for myself. I need to be present at the moment to focus on what I'm doing. And when I'm done with it, or if I can't find an answer, I kind of park it, come back to it later and then move on. And then be present for the next thing.
Also do podcasts.
And also do podcast, yeah. Yes.
Yeah. So one thing I've realized, it's true that you said you can't really support the portfolio beyond a certain point if you don't specialize, like in whatever sectors that you've invested in. Otherwise, you look like an idiot.
Look, you can always continue supporting if it's just capital, right?
Yeah.
But I think we pride ourselves in at least try to be more than that. And I think as an early stage VC, that is quite important. And I think with our platform, we have the privilege of looking for patterns across our whole host of portfolio companies that we have invested into. So, yeah.
So we talked about a lot of contradictions within venture capital, but if you were to tell your, younger self 10 years ago, what would be the contradiction that you would recommend he or she, your younger self, embrace rather than, fight?
VC is ultimately a numbers game, whether it's the power law, is about making returns. But it is also a people business. So we have to think rationally, analytically about a given issue, but we also need to have so much empathy and emotional intelligence to deal with situations. I feel passionately about what it means to have financial discipline as a VC and as a startup founder. And I can talk on and on about it. I believe that having a robust financial model is key to even early stage startup. It's not only for performance monitoring, it's an important tool to chart the growth of the company. I truly believe in that. And it would be a mistake for founders to, I feel, not focus on that part. But on the flip side, as we discussed earlier, especially for early stage investing, the founder pool, their competency, the dynamics between the founder, people aspect of the business is so key, because ultimately it is this team that will bring the business through good times and bad for the next 3, 5, 7, 10 years of the lifespan of the company. And it takes a lot for the founders to do what they do. They give up a comfortable job. They have to hear no's from so many VCs before they get the funding. They have to hear no's from the clients before they get the first contract. It takes a lot of courage. It takes a lot of sacrifices. So we cannot be too hard-nosed about certain things sometimes when we underwrite or deal with founders, right? Beyond just underwriting the founders and the founder dynamics, probably the fit between the company and the fund, the founders and the investment manager is also quite important, right? Having the right chemistry, having the right values, having the right philosophy about certain things can help to build trust. And trust is so important in any long-term relationship. So yeah, it's about numbers and it's about people. And I have thought long and hard about whether one is more important than the other for a long time. And I don't think that either is more important than the other. They're both equally important.
Okay, one question. What are the kind of founders with whom you can build good relationship? Like, what would be the kind of founders where you have like a good founder investor fit?
It's a good question. I'm thinking of the current pool of founders that I'm working with. They're also different though. They're all really so different. We have a mother, we have someone who's a bit more senior with prior research experience. We have people from the food industry. We have people fresh out of college. It's super diverse. Maybe the skill here to build is for me to be able to work with different type of founders and figure out a way to be able to find that investor-founder fit. Perhaps.
Okay. This was great. Thank you so much for taking the time to do this, Puiyan.